Accounting, Chapter 2. As already discussed, finance is a blend of accounting, economics, and other disciplines. This chapter will prove invaluable in establishing the relationship between accounting and finance, whether you have taken accounting or not, and it was a prerequisite for this course. I hope you enjoy our review of accounting. The four basic financial statements are the income statement, which measures profitability, the income statement of retained earnings, the balance sheet, which shows assets and the financing of those assets with debt and equity, and the statement of cash flows, indicating the change in the cash position of the firm. The income statement is really the device to measure the firm's profitability. It covers a defined time period. It's presented in a stair-step, or what's known as progressive fashion, so that we can examine profit or loss after each type of expense item has been deducted. The income statement begins with the aggregate amount of sales or revenues that are generated within a specified period of time, the various expenses that occur in generating the sales are subtracted in stair-step fashion to arrive at the net income for the defined period. The separation of the expense categories, such as cost of goods sold, selling and administrative expenses, depreciation, interest, and taxes, enables the management to assess the relative importance and appropriateness of the expenditures in producing each level of sales. The bottom line value, net income, is the aggregate amount available to the owners. Net income is converted from an aggregate value to an earnings per share value by dividing net income by the number of shares of outstanding stock. The EPS is a measurement of the return available to providers of equity capital to the firm. The return to the providers of debt capital, interest, appears earlier in the income statement as a tax-deductible expense. The earnings per share may be converted to a measure of current value through application of the price to earnings, or P/E ratio. The P/E ratio is best used as a relative measure of value because the numerator, price, is based on the future and the denominator, earnings, is a current measure. There are limitations associated with the income statement. For example, the income statement reflects only income occurring to the individual or business firm from verifiable transactions, as opposed to the economist's definition of income, which reflects changes in real worth. Furthermore, flexibility in the application of generally accepted accounting principles may cause similar events to be recorded and reported differently. The statement of retained earnings, a supplement to the income statement, indicates the disposition of earnings. Here we wrap up the price to earnings ratio with some important points on this slide. The P/E ratio allows relative market value comparison to many companies. Firms with higher expected returns have higher P/E ratios, and price to earnings ratios can be confusing when a drop in earnings may not match the magnitude of fallout in earnings, which causes an increase in P/E ratio. Here are some price to earnings ratios for some selected U.S. companies to review. A recap of the limitations of the income statement once again. And in our next segment, we'll move into the balance statement.